Welcome back, folks. Part three, CIOs and bow ties with Dr. Crook, or Mr. Crook, I should say. I got my tribute to Kobe Bryant, my girl dad shirt. I am a legitimate girl dad, so I believe I'm eligible to be wearing it.
You're entitled to wear that, indeed.
I'm entitled to it, yeah. Okay, we got a fascinating discussion, I think, on investing and emotions in investing. And, there's two things that have happened fairly recently in markets, I think, just demonstrating how extreme markets have become. So the first one, which is we've actually lived with for probably the better part of a year or two now, is this concept of negative interest rates. And the other one is negative oil. We'll deal with them separately. So here's my view on negative interest rates, just if I can try to sketch this out. Negative interest rates is basically a torrent of money buying bonds. So I'm wondering if the emotion there is, if you're buying something, the emotion tends to be one of greed. You're buying something because the price goes up. The price of bonds have gone up so high that the yields are now negative, if you will. But again, I'm not so sure that's the case when it pertains to bonds. The reason people have been panic buying of bonds, specifically treasuries, long-term treasuries, may be actually out of fear. It may be a fear-driven emotion, not a greed-driven emotion, as they think, maybe deflation is coming about. The way to protect other risky assets is to go to non-risky assets such as treasuries. I'd love to hear your comments on specifically negative rates, David.
Greg, I think you're right. We do have to be cognizant of the fact, though, that we do have central planners that are the ones that are, perhaps they started the move and they're looking to continue. And so, the central banks, the ECB, the European Central Bank, the Bank of Japan, the marvelous Federal Reserve Bank and the like, who have also contributed to that. But the bottom line is, yes, you saw that in March of this year. You saw when people got nervous, when there was dislocation in markets, people ran for those assets that they felt were the most secure at whatever price. And that takes us, by the way, to what happened to oil late last week and earlier this week, when due to financial markets, really, the price of oil went negative. And I'm talking about WTI, West Texas Intermediate, went negative. It's not something we would have even considered prior to these events actually happening. But they did, and we have to adjust to them. And we have to be able to look at these dislocations and determine where the opportunities lie as investors. That's the secret here, is there have been dislocations. We'll go back to why they happened. And I quite agree with you. Fear is certainly one of those elements that contribute to it. And then how do we get rid of this fear and look for those opportunities and move forward?
Okay. All right. There's a lot to dissect there. So let's talk about oil for a second. Maybe you can run us through the mechanics. So the price of the front month, that was May, the maturing futures contract went negative. And so my understanding is people said, listen, I don't want to be caught holding a May futures contract, because once it matures, I actually get a knock on my door and somebody's going to bring me some barrels of oil. And those barrels, I got nowhere to store it. There's nowhere left to store it. And so in a rush to get rid of it, people basically sold the May contract, sending it into negative territory. Do I have that right? Do you have anything to add around the market mechanics?
No, that's correct. If you can't find a futures contract on the other side of your open position over here in the US, then there is physical delivery of the commodity. So if you own those contracts and you were expecting oil delivery, you were going to get the oil delivery if you couldn't offload that contract. That's exactly right. There is nowhere to store oil, as I understand it, in the US today. People have reallocated fracking tanks. They've reallocated salt caves outside of Houston. There are any manner of means to find where we can keep this oil that is not being used. This is a demand issue, by the way, is what it all boils down to. At the end of the day, the world is using far less crude and oil product, given the shutdown. You only have to look at the roads and look into the skies above to know that airplanes aren't flying and cars aren't driving. So with that being said, demand is not there. Supply prior to this had not been affected that much, although I will tell you the land rig count in the US today has dropped dramatically, with smaller companies who had, give or take, 40% of the land rig count in the US having reduced their holdings more than anybody else. But if you've got oil, you have to be able to store it somewhere. And that was the issue with regard to WTI this past week. You didn't see that in Brent crude, a more globally traded commodity than WTI, but you certainly saw it in WTI.
How about storing some crude oil on cruise lines? Surely they're not being used very much, right? No, that's a bad joke. Yeah, that's a bad joke. So just taking that analogy then onto the interest rate side, I guess there's not a problem with a physical delivery of a bond, if you will, because they can always just create more bonds. So that logic doesn't hold for a negative interest rate, right?
Well, you can only create more bonds if the people are going to buy them. I mean, you can't issue a bond if there are no buyers out there. Then the bond, to all intents and purposes, hasn't been issued. Perhaps another a weirder example of that, Greg, is if we go back, and I believe this to be true, that a Norwegian bank sometime last year, if I'm not mistaken, time escapes me somehow these days, but a Norwegian bank issued a mortgage to an individual at a negative rate. That is to say, they paid the family to finance their home for them. And the reason for that is if they could get rid of those funds at negative 0.1, and they were getting those funds in at something less than that, then they were still making money. There was still a margin, and it wasn't on their balance sheet. But I mean, just weird and crazy stuff has happened and will continue to happen. Black swans, they exist already.
They're less rare than you think.
It's just, you got to find it.
All right. Well, so let's play this out a little bit. You know, on the interest rate side, that's government created negative interest rates to a degree, right? But they continue to issue into this negative rate scenario, and to a degree, financial markets have created this negative oil situation. So have governments now proven conclusively that they can override the economic cycle, that the fear and greed cycle is now, for all intents and purposes, excuse the term, flattened?
Well, Greg, if these Keynesians in these positions of power really believe that, they're naive. However, I will tell you, I've heard argument over the last 2 weeks from some very, very smart parties within financial markets talking about the ability of central banks and their governments to essentially net off their individual balance sheets. And the argument I heard, I don't quite understand it yet, because I can't understand how there are not long-term ramifications for all this debt that we are creating. But there are arguments in place that's saying, in due course, we've seen it in 2008, we've now seen it in 2020, the central banks can create money in much larger numbers than you would ever have imagined in the past, ever. I mean, we wouldn't have even considered it. And what are the implications? Well, none really. So why should there be in the future? Interesting argument. I don't quite understand it, but time will tell.
It will. I don't buy it simply because the natural cycle of fear and greed is so inherent in the human being. It's been with us for thousands of years that I can't see it being negated. But anything is certainly possible. Let's see. Tell us, just make it a little bit more relevant, if you will. How, as a financial advisor, how should you then, given all that we've discussed, think about your relationship with your clients? I mean, what are you there to do? Is it different to what we think?
That's a lovely question. I will begin by saying neither Greg or I are financial advisors, right. But certainly those that are within our organization, I hope recognize that they're really not financial advisors in terms of what the term suggests. They are relationship managers. And as you pointed out in preparation for this call, they really ought to have a degree somewhat or some study in psychology, because they are dealing on a day-to-day basis, particularly when they're crises, of course, with psychological upheaval. And they have to know how to address that. And they take the responsibility of removing the emotion from those investment decisions on behalf of their clientele.
Yeah, so an advisor almost has to have a psychology degree, as it were.
Certainly be useful, that's for certain.
Yeah. Well, great, Dave. Listen, fascinating discussion. Let me just recap. So we're talking about market cycles with reference to an article called The Market Cycle of Emotions that was put out by Russell Investments. Again, we'll put the link down below. It talks about, the movement from euphoria to despondency. And again, I'll leave you with what I said in the first part, which I thought was very interesting. Warren Buffett is always famous for saying, you don't actually have to be a genius to be a good investor. I think what you really need to do is to have a handle on your emotions. In other words, there's a famous saying, buy when there's blood in the streets. What's the opposite? Sell when everything's euphoric. Easier said than done. It's really easy to say those things, but when you're in the grip of a mania or a panic, very, very difficult to actually execute on that. So great discussion, really appreciate it. And I'll throw it over to you for any closing words.
Well, as always, folks, thank you for your time. We appreciate you looking at these two ugly mugs, and hopefully we've been useful in terms of our output. With that being said, stay safe, be careful, don't rush out there, no matter what some governors might suggest you do. With that being said, we look forward to our next one, Greg, which hopefully we'll do sooner rather than later.
Yes, indeed. All right, you be safe as well. Take care, Dave.
Bye.